there, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action here on Wednesday, June 26th. We'll talk about the late-stage rally as the S&P spiked to the upside, just narrowly missing a close above 5480. We'll also talk about sector themes because only one of the 11 S&P sectors actually managed to have a decent update. Everything else was flat to down. So index is higher with weaker breadth conditions continues to be the word of the day. With that in mind, let's get to our market recap here and see how things played out using the charts here on Stockcharts.com. You can see the S&P 500 finished today around 5478, and here's that spike I was talking about on the last hour of trading. It really accelerated in the last 15 minutes of the session. The Nasdaq Composite actually finished up about 0.5% to just above 17,800. The Dow was flat for the day, again after the run higher at the in the end. Small caps were flat. Mid caps were down about 1/3% to 2913, 2912 for the S&P 400 mid cap index. The VIX remains relatively low. We're down about 0.3 VIX points from Tuesday's close. You currently have a VIX level around 12.5. So again, low VIX means low volatility, low uncertainty. At this point, low risk of a lot of downside, right? But elevated VIX is always the thing you look for, in my opinion, in this particular sort of environment. Interest rates, you can see overall moving to the upside. The 10-year yield finished today around 4.32%. The long bond yield's around 4.45. The short end of the curve, of course, still remains fairly elevated. We have, economic data coming through tomorrow into Friday. I would argue that is, besides some earnings, which is not significant earnings, but more, for individual companies, certainly of meaning. But I think the economic data to see if we can continue to see economic strength, because stronger economic data today means tomorrow, meaning the first Fed rate cut, most likely pushed further and further down the road. Theme we're going to talk about today a little bit. We haven't talked often about the chart of the dollar. We usually refer to it in the market recap. The dollar is up about 0.5% today. I think that's important to note because a strong dollar is usually not good for the S&P 500, and we'll show you that chart and what that might mean. Commodities overall kind of mixed today, but precious metals certainly lower. The gold ETF GLD finished down almost 1%, about 0.9%. Silver down about 0.4%. Crude oil prices slightly lower. Natural gas down as well. Cryptocurrencies all in the red, rotating lower. Bitcoin did get up to around 62,500. Just missed that point before rotating lower. Now we're rapidly approaching the 60,000 level yet again. Big round numbers support continues to be a thing. It's currently down about 1.6%. I mentioned sector themes. Look at this. Again, narrow sector leadership. Only one of the S&P sectors, consumer discretionary, had a decent update. XLY was up about 1.5%. Now, Amazon's making new all-time highs this week. That certainly is not hurting the XLY. But again, when you talk about broad advances, right, the market advancing, a healthy bull market phase marked by healthy breadth conditions, that is not how I would describe the market right here. We continue to have a very narrow group of leading names. Communication services was number 2, flat for the day. Materials and technology were down slightly from yesterday's close. 3 worst performers were energy, financial, utilities. Energy only down about 1%. So again, without XLY having a decent update, it was a pretty sort of mild flat to down day for the S&P 500. Keeping track of our market trend model through the course of the week. Again, I don't formally update this until Friday's close. This is what it looked like on Friday's close. Updating it for today's close, we're kind of right around that same level. Mid caps appear to be weak in the short-term time frame, along with small caps. Small caps also weak on the medium-term time frame, but our main core model using S&P 500 data remains bullish on all 3 time frames. Looking here at the leading growth names, what we might call the Magnificent Seven and Friends, you have Tesla pushing higher. Tesla, Rivian having some great news today, pushing to the upside. Tesla was up almost 5% at the close, almost getting to $200 a share. Amazon nearing $200 a share as well. That was up 3.9%. When you think of why the XLY is up so much, you have Tesla and Amazon. The 2 of those are getting near around 50% of that ETF, probably around 40-50%, and they're both up in a pretty decent clip today. Apple as well, up about 2%. Alphabet finishing slightly lower, just a rounding error below Tuesday's close. Alphabet, of course, new all-time high here in June, and again, we're continuing to see strength in some of these largest names, generally speaking. That is what is allowing this market to remain incredibly strong. Let's go to a daily chart of the S&P, just check on how things played out through the course of the day today. Again, sort of a broken record about how this market has been trading recently. The last couple of weeks have really been much ado about nothing. After that push higher about a week and a half ago, the S&P has sort of stabilized between 5450 and 5500. It looked like we might get it close above 5500 with that late hour rally, but not enough to push us above that level. Again, we've never closed above 5500 before, so we'll see if we're able to do so. Again, as a trend follower, with this sort of market where the chart is making higher highs and higher lows, I assume that a market like this is innocent until proven guilty. And what that means is you assume the uptrend will persist, and you just have some signal, some check, some indication to look for that would tell you that uptrend is no longer in place. For me, 5,400 is that level, that line in the sand. That's the gap that we saw from earlier in the month of June. S&P below 5,400 would mean, number one, we'd be pushing below that price gap, which is an anticipated level of support. We'd also break below that pink trend line, which uses the major lows over the last 8 or 9 months. And so I think that 5,400 level is kind of the level to watch here. As long as we remain above that, conditions aren't that bad. Now, what will seasonality tell us about the likelihood of a major breakdown in July? Here's the thing, the market actually doesn't break down too often in the month of July. If you go back to the 2009 market low, so I'm using our seasonality chart, I'm going from 2010 to 2023, and I'll explain what this chart is telling us, and then I'll show you how you can set this up in your own login. When you're looking at the S&P 500, here we're looking at the last, 14 years of data previous to this year. The histogram is measuring your batting average. So this is telling you what percent of time that month has been a positive month for whatever ticker you put in there. The numbers here at the bottom of the histogram tell you the average return. It's a simple mean. So you add up the total number or you add up the returns and average it by the number of months that or number of years that you're calculating. That gives you the average or the mean return for that month over the period of time that you're doing it. I use this slider to bring in more or less data. I like to go back to the 2009 low because I think the market post-2009 is a certain regime that we can probably think about as sort of the secular bull trend. Note that there are 3 months that stand out as exceptionally and consistently strong. Number one is April, which we talked about earlier in the year when we didn't have a lot of weakness in Q1. April actually tends to be quite strong. This April was actually where you had a major low, though. Probably the most significant low year to date was in mid-April, so it's sort of against what you might expect there. November also quite strong. 86% of the time that has been positive with an average return of 3.1%. And that is the exact reading you will see in July, which is the month we are preparing to start. As we wrap Q2 and we begin the third quarter, the month of July, since the 2009 low, has been almost 100% positive, right? 86% of the time, July has been a positive month. The average returns are positive 3.1%. So if you're thinking major market top and it happens in July, it is certainly possible. Don't get me wrong, that is possible. But John Kosar, a friend of Stockcharts TV and a frequent guest on our channel, likes to compare this to riding your bike, right? You can make progress riding your bike into the wind. You can go places, but it's just a lot harder. It's much easier when you have a tailwind, when you have the wind at your back, and you're able to go a lot faster, a lot more easily. And I think that is the challenge with seasonal tendencies, right? If you're bearish here and all bared up going into July, the chances of us having a July peak based on the seasonal tendencies are actually quite low. But don't look too far to see that we then get into August, which is one of the worst performing months with one of the worst performing, worst average returns. And then September, which is, again, 50-50 coin flip and is the worst average return going back to the 2009 low. So if we don't have a major peak in July, and maybe that strength that we see seasonally in July sets us up for an August-September sell-off, exactly like we experienced last year in 2023. That's pretty much how that year played out. So interesting to think about the seasonality. And again, seasonality for me is sort of a headwind or tailwind thing. At the end of the day, price is king. Price is what's most important. So you want to look at price indications more than anything else. I want to talk briefly about the U.S. dollar. As I mentioned, the dollar having a decent update today, up about 0.8%. This is the chart of the dollar that I like to use, $USD. And as a reminder, what we're looking at here and the level we've talked about is 107, right? And 107 was the peak from Q4 of 2023. You can see 106 is sort of where we stalled out in April and May of this year. And we are right back up after today's gap higher to that 106 level. I think getting through 106 to 107, if we can get above 107, that's a pretty dangerous sign for stocks. Now, why would that happen? Well, first, one more technical comment. I would say a couple thoughts on the chart of the dollar. Note the higher lows, right? So if you think about year to date, what has the dollar done? It's made a series of new highs and a series of higher lows. So getting above 106.50 would continue that pattern of higher highs and higher lows, and I think further validate the fact that there's a primary uptrend at work for the U.S. dollar. The momentum characteristics would agree that that is the general sense here, right? We became overbought in April as we were last at these levels. When we pulled back, the RSI didn't get much below 40, so that's pretty classic for a bullish market phase as the chart bounced off of the 200-day moving average. As we push higher again, I would assume that this chart is innocent until proven guilty. Now, why would a stronger U.S. dollar be bad for the S&P 500 or the Nasdaq? But you have to remember these big multinational companies. Think of the companies at the top of the S&P with a lot of operations outside the U.S. What you have to remember is any of the sales that Apple makes in China or elsewhere, when they convert those back to U.S. dollars, the stronger the dollar is, the less those foreign revenues or foreign-based revenues are worth when you convert them back to U.S. dollars, right? So the money you're making outside of the U.S. is just less valuable when you turn it back to dollars. So your revenue sort of tends to be a little bit lower. And the question is always, can companies earn enough that it compensates for the weakness in the currency transaction, or the currency loss that you have in the currency transaction, the lessening of the value of those revenues. Still to be determined, but I would say, stronger dollar probably matches up with stronger economic conditions, which is probably good for companies, meaning that the expectations are strong. But again, the stronger dollar tends to erode the value of those returns that they're making outside the U.S. That's why strong dollar can be a problem for U.S. benchmarks. Usually better for small cap stocks, which aren't victim to those that negative impact of a strong dollar, because they don't have as much of a revenue stream outside of the U.S. So something to watch as we continue to see a stronger dollar. Look back to 2022 if you want an example of what happens when the dollar is strong and everything else is weak. It's a rough place to be. We'll finish off here looking at some stocks on the move, in the news, certainly showing that their charts cause you to or compel you to pay attention. FedEx having a decent gap higher. This is the top performer in the S&P 500 today, up over 15%. FedEx is in the industrial sector. It's in a group called Delivery Services, along with UPS and other delivery names. But overall, you can see sort of an interesting chart here, right? And if you look, resistance in December around 280. Earlier this year, late March, we were around 290. Today, we gap higher to a new all-time closing high. Now, anytime we have a big gap like this and we gap above resistance, the question is always follow through. So I think between Thursday and Friday will be very important to see if we see additional buyers coming in. Now that FedEx is at a new 52-week high, do you see willing buyers willing to pay $300, $310, $320 for the same company, given the optimism that we experienced after earnings? That's what happens, right? The stock gaps higher on earnings as investors sort of digest these higher expectations. But at some point, you have to question whether it's worth the additional capital that you need to accumulate more shares. The RSI is up around 80. You can see previous times we've been up in that extreme level. We have had a bit of a pullback after a gap higher, most recently in March. We gapped higher at the end of March. Similar story, strong earnings, strong upside. Look how we never got above that gap day's high, and that's why I think it's important to watch FedEx through the remainder of this week to see if we're able to change that pattern, buck that trend that we saw in March. Electric vehicles having a nice, decent day. Again, one of the reasons why the XLY is so strong today. Tesla and Amazon making new swing highs. Tesla did not quite get above on an intraday basis the April peak, but it did on a closing basis. I think for Tesla, the real question is this 200-day moving average looming large above current levels. We're just below $200 a share, so I see this working one of two ways. Number one, or I guess option one, we stall out during this attempt to retest the April peak. We don't really get above the 200-day moving average. That would suggest at least a mean reversion back to the previous support levels around 170, or we're able to follow through above 200, 210, get above the 200-day moving average for the first time since early January of this year. If so, I would say Tesla a strong chart with certainly upside to test the late 2023 highs, if not more. But we have to get above the first level. We have to walk before we learn to crawl before we learn to walk, as it were. We'll see if that's able to happen. Rivian, of course, there's some great news today. Now, Rivian, a bit of a different story. Tesla gapped higher and traded higher. Rivian, the opposite. Rivian opened above $16 a share, but closed here down below 15. It gapped above the 200-day moving average, but by the close had closed back below the 200-day moving average. This is giving me a much less optimistic story about a company gapping above resistance at 12. Seems really encouraging, but did you see a bunch of willing buyers come in and willing to pay 16, 17, 18 for the stock? The answer is no. The gap higher caused a bunch of selling as investors were thrilled to take a profit on something that they bought back here, or maybe they bought back in January, February. They're thrilled to make it back to their entry point. They unwind the position. They're happy to go on to somewhere else. This is a gift. Rivian this high and potentially move lower. So keep an eye on this gap between around 12 and just above 14 to see what happens next. Now, Amazon, of course, one of the strongest names, biggest weight in the XLY, making a new all-time high again today, up almost 4% today. Charts like this at a $2 trillion market cap, doing what they're doing, breaking above established resistance at 190 is what will cause the S&P 500 and the Nasdaq to continue to push higher. We'll finish off with the chart not looking particularly great. And I would say as you're looking at an Amazon breaking out, you're looking at Super Microcomputer, MicroStrategy, any of these names that have had these beautiful uptrends, and you're wondering what's the risk, right? What would a dangerous pattern look like? I think Corning is the cautionary chart that shows you what can happen. This is the danger, right? Making new all-time highs, continuing to make higher highs and higher lows. All of a sudden you have a big drawdown. Now again, it's not the end of the world. Let's be clear, right? If we take the chart of GLW, draw a simple trend line off of the recent lows, off of the major lows that is, you can see that this is sort of your general trend line that I think captures the long-term trend, right? The October 23 low, the April 23 low. You got a lot of room and still be within a nice uptrend on sort of the weekly time frame, right? Now, in the short term, we can also do some short-term trend line analysis. So let's draw more of a steeper trend line, sort of hitting these levels. And I think this is where things get a little more concerning, right? Look at the low, and this is a horribly drawn trend line. Hold on, let me make that right. Here we go. We got this one here. I'd probably take it there. I'd probably draw it there. So there we're taking the low from mid-April. We're connecting that to the low in May. That lines up beautifully with a couple lows in June. And unfortunately, we closed just below that level today. So I think the risk for a chart like GLW is that this is the beginning of a further deterioration. Now, what do you do? How do you differentiate between a brief pullback and something more significant? Well, number one, the concern I have going into today is this bearish momentum divergence. The fact that higher highs in June have been met by weaker momentum. That's a concern. Question two is, do we see follow-through below that trend line break? A lot of times you will see an initial breakdown of a trend line or support level. The next day you move right back up. And I think that's what could happen with GLW, to see if you actually get follow-through or if we rebound. This is a bit of just a whipsaw. Finally, if we do break down lower, we've got a lot of support below current levels. The 50-day moving average is pretty far below, just above $35. So maybe something like the chandelier exit or something that's a little more based on average to range could help you lock in gains and eliminate the chance of participating in a big downdraft, but make sure you lock in some of the paper gains that we've seen previously. We'll see, right? So overall, I would say charts like Corning, that's the concern. Again, it happens on Corning. It doesn't really move the needle on the major benchmarks, but something like this happens with NVIDIA, happens with Amazon, happens with Meta, Alphabet, these big names with big cap and big influence on the indexes. that's when a pretty strong year can look very weak very quickly. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close for the final bar. We have a lot of really cool content in the works, a lot of great conversations with guests. We have our top 10 charts to watch for July 2024 coming up this Friday with Grace and Rose. By the way, one of the tickers that I went through today is one of those top 10 charts, so make sure you watch on Friday to see which one it is and also see the other 9 names that we suggest you pay attention to over the next 4 to 5 weeks. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.